Happens if I log out and back in? Dang it. All right, let me try logging out and back in if you guys can't hear me. No, now you can hear me. That's weird. I did basically nothing. I'm not sure why that started working. I just clicked two buttons the same way. All right. Well, my apologies. Gotta love tech issues, right? So I had a nice long conversation with myself, but basically I'll try to summarize it shorter since I lost 15 minutes of explaining how I'm looking at the market here. But generally right now we've got a chopping downside market, and the market is unable to catch a bull mode because right now we're negotiating without negotiating. So the analogy I gave with with the United States and Iran is the idea of trying to split a $10 pot. So if I told two of you, Fred and Ted, I'm going to give you guys $10 to split, and as long as you agree on how to split that $10. Fred says I want $9. Ted says I want $9. So you say, oh, we don't have a deal. So you get nothing. If Ted said, fine, Fred, you can have $9, I'll take $1, you'd both be better off than both getting nothing, but it doesn't seem fair to get $1 when somebody else is getting $9. The best scenario you can really come to is likely that both of you get $5, but at the end of the day, you'd be better off taking $1 than taking nothing and letting the other person have $9. That's kind of a baseline of I think where we're at with how we're negotiating with Iran. We're saying, hey, there's a big pot here, and the United States might be saying, I want it all. I want that unconditional surrender, and I want everything. And Iran is saying, well, no, hold on, I want everything. And we don't get to a midpoint where it's a fair negotiation. And I think that's what the market's pricing in right now. After the United States sends to Iran, here's our list, and we're going to meet. And Iran says, we're not going to meet, but we'll look. I think that's telling the market, you gave us a list that we're not going to accept. If we were going to get close to accepting, we'd sit down and meet, but we're not going to. So that's where I think this market is reacting to the downside right now. It's a chopping market. It's a return on capital trade, and it's about managing positions where reducing shorts and hedges on dips and reducing longs into rallies, and then rebuilding over and over. If I've got a long stock position, I can hold a long S&P position if I've got a put and or a short call. Now, if I've got a long put with or without the short call, on a dip, I can roll down my put, so I still have exposure, and I've booked some profits. I've generated some cash. And then into a rally, I roll back up my put. So I pay a little bit of money to put back into the market. And now I've got something a little bit better hedged for my position. And, kind of lather, rinse, repeat. And that seems to be what the market's doing, is effectively trading around the moves. So we see the skew going down on downside moves. So let me pull that up after. I'll pull that up real quick. Like the market skew, put skew tends to go down when the market's down. Today, it's down a little bit with the market down. When the market was rallying, put skew was going up. People buy puts into recoveries and sell puts into dips. They're managing the hedge. Got a weird print this morning. Market's down $6 today, $5.50, $6, and we're getting close to the lows. And we could go into falling knife mode, and so be aware of that. 10-year Treasury yield had spiked over 4.4, fell down as we started looking at maybe we're making progress with Iran. Now it's back up because there's no real progress. Yes, William, I talk to myself. I respond to myself. We've got great conversations. I'm a lot of arguments though. I'm kidding. MMFI back above 30, but not meaningfully so. It'll be back below 30 today. We're generally in a bear market with bounces. So bear flags are the setup in the technical side of things. 1, 2, 3 days of bounce, and then potential for new downside. Test of support may find some short-term stall out, but we get through that and it gets to falling knife look for a day or two. And then profit takers bounce us back. Fundamental updates bounce us back, but the fundamental updates don't seem to be going anywhere. For Bitcoin, Can't seem to get a rally. I do think it was interesting this morning. There was an announcement from MARA Holdings. So one of the stocks that I've been looking at is a Bitcoin exposure to the long side. Mara is selling out 15,000 Bitcoin in order to turn around and buy back convertible notes. Mara also announced that they are converting some of their Bitcoin, whatever, big factory buildings to manage AI power generation instead. So there's a twist in their fundamental structure. It looks like they're moving from holder of Bitcoin as a long-term strategy to, all right, well, we'll do power generation and servers for AI. Kind of chasing what might be more profitable in the short term, since Bitcoin doesn't seem to have that oomph anymore. We've seen that a few times with some of the other AI companies, basically moving towards these Bitcoin miners, Bitcoin repositories, Bitcoin, big sprawling server farms, and saying, I want to convert you from a Bitcoin miner to a AI power or AI server farm. And that seems to be some of the change there. MSTR is not changing that, but just kind of keep that in mind that if there is some movement that direction, there may be fewer and fewer of these Bitcoin plays out there outside of MSTR. If Marathon and MARA and Riot are moving away into the AI side of things, those are now exposed to two different elements, AI and crypto, instead of just crypto. And that also, I think, kind of tells me a little bit about the way that things are going in crypto, where it's not sexy right now. So these companies are looking for something that's going to get investor in involvement again. Yeah, and that's dead on, Fred. We can't get an unconditional surrender. We don't know who's negotiating. I didn't see that Morgan Stanley's rolling out their own ETF for Bitcoin. That's also good to know. But Bitcoin, like, when it's hot, everybody wants in. When it's cold, everybody wants out. It's for those of you that are unfamiliar with Giffen goods. Giffen goods are this idea that traditionally, when price goes higher, supply increases, demand decreases. I think crypto is very Giffen goods style, where it goes the inverse. When price increases, demand increases. The closest thing I've heard from like a hard asset that is a Giffen good would generally be rice. So rice, when prices go higher, people have to spend more of their income on, especially in third world countries, on the rice that they consume, and they can't buy other, other foods that are maybe more desirable. So demand for rice actually increases because more of the diet becomes rice when the price of rice goes up. So that filler in terms of calories and things like that. But then in terms of like other assets, non-agricultural related, Bitcoin, maybe art, demand goes up when the price goes up, because there's just this like chase effect, and it creates that parabolic shift. I think that's the way that Bitcoin generally operates. The more it goes up, the more people want it because they think it's going to 1 million again, or they think again it's going to 1 million. Not going to 1 million again, but they think again that it's going to 1 million or 1 billion or whatever, ridiculous number people want to put out there. Ultimately, the high is around 125,000. But if we get back to 100,000, I think that there's going to be a lot of chase buyers of crypto, and that's an asset that you actually get the chase buyers, and it kind of works. So right now it's a boring market, and I think for me, until I see more risk on in crypto above 75, I'm shifting my viewpoint of maybe it's just time to let this stop trying to find the bull case here in crypto and wait for it to be a little bit sexier and have it be a bigger focal point for the market, as well as all these companies that had been buying into it. So to the broad market, the S&P down at the lows got down to 650. You know, we were saying yesterday, it's like it's at 660. Maybe we go to 670, 675. Maybe we go to 650, 645. And we tested 650 this morning, and maybe that's all we got for today. Maybe we bounce back. You can see a lot of this chop happening. This technical formation is muddy and takes time to get clear. It was downside recovery for 2, 3 days, then downside recovery for a day, downside for a day, up for a day, down for a day. We're actually starting to tighten up this range where the downward trend is getting, we're getting lower highs, but we're getting a bit more of a stable low. That can shift tomorrow. Tomorrow we can trade 645 and then go back to saying, okay, never mind, bear market with bull flags, or sorry, with bear flags. But right now it's a bit choppy near the lows. That may be signs of some of the bottoming action, but I think it's still more than anything a sign of the trading behavior. If I've got shorts and I don't sell on the lows, when we bounce back, I don't really get paid if I'm long a bunch of 675 calls. Those don't really perform. So if I'm long 675 calls that I bought into, say, back here, then I hedged when we started to fall. Then we start to bounce like this. My hedge is losing money because of theta. My long call is losing money because of theta. And I'm actually just losing money in spite of having a delta neutral position. If I've got long gamma, long calls with long puts for a hedge, I got to trade them. So people are getting trained to trade. Sell the puts on dips, buy back into puts on rallies, and maybe hold a longer term long position. And because we've got that selling of puts on dips, the VIX doesn't explode to 40. Now, if we get to a falling knife, we get below 645, I think the VIX can explode. Because then that selling of the put turns into having to scramble back in and getting back in the market. So my approach to this is for a long-term investment portfolio, if I've got puts, trade around them, but don't sell them. SKU's coming down. Just means that I can get cheaper further out of the money puts. Roll them down. Then I've still got my my protection to the downside. And yes, I'm not capitalizing on the full sale of a put. If I sell out a wrong one, go to SPY. Come on, there you go. If I have a May, or let's say it's a May hedge. If I've got a May 650 put as a hedge, yesterday, these puts were trading at around what? $16-ish on average during the day. So yeah, I could sell them out for 19 today and make a quick 20%, or I can roll them down to the 625 puts today. So I collect $7 ish on the put credit spread, but what I'm really doing is selling my long and buying a short, and then into a rally, this thing gets back down to $6, and I'm trading that dollar back and forth, buying it back for $6, or rolling it back to the 650s, paying $6, rolling it back to the 625s, collecting $7, and just trying to trade that range against a long position, so that if the market does go up and we do start to get some resolution, now I've still got the long exposure to offset the hedge. So it's a trading the hedge market for me. Now, I got a note again. We've got a webinar, Vlad and I are going to be talking about managing portfolios in a downward market like this at 1 o'clock Eastern today. If you don't have the link, let me know. I can make sure to send out. We'll send out an email with the link if you haven't seen it in your email. Talking a little bit more about this sort of stuff. But I think that this is the market that we've got, is trading the hedge, not abandoning the hedge on the downside, because then if the market does fall off, now I'm just stuck long and exposed and stuck not knowing what I want to do. And reducing the hedge can be done by rolling the position and still having the same number of shares protected, as opposed to trimming the hedge by just selling out puts. So, in any case, go to IWM. Small caps down 0.4% today. Generally had been getting bought up again at the beginning of the year, had to dip down to the 200-day moving average. Generally look much better today than the broad market again. People still like some of this, and I think part of it is that there is some energy exposure there in IWM. So with energies being a reasonable percentage of IWM, that's keeping it up. Because XLF, even though it's unchanged today, has been a disaster since the beginning of the year. Disaster on a relative basis. It's down, what is that, 12%, 13%, 14%. So it's been a rough run for financials. That's a broad economic viewpoint. People are worried about the economy, so financials shouldn't be going up yet. But it is, again, showing maybe a few days, maybe giving us a crystal ball into the future, or a look into the future where we have this downward trend and we start making bottoms in SPY. Like, we're here for SPY. XLF may be a week ahead of it, where this downside keeps getting held up and the lower highs are converging down onto the lows. So we get to an inflection point. And when we get to an inflection point, something exciting may happen. XLF looks to be making that inflection point happen right now. A descending triangle. So lower highs, stable lows. We're getting close to this convergence. And then at some point, we either breach the downward trend and start to make upward moves happen, or we breach that downside support and go into falling knife mode. Traditionally, I look for this for the bear side of things, but it could be a short squeeze play, or if there's a fundamental input, then that'll dictate which one wins. But we may have to get some sort of resolution from this without a fundamental input. But my general bias is that lack of fundamental input is generally bearish for the market. What we're dealing with right now is generally not good for the economy. So I see minimal scenarios where we just stop moving and wait. The longer it goes on, the worse it can be. The resolution is bullish. The escalation of issues and the movement further away from each other in negotiations is bearish. But just sitting where we're at right now is also bearish. We're at that point of we want to split that $10 pie, and both sides may end up with nothing and just spend a bunch of money debating how to split a pie and spend more than what we end up getting out of the end result. So overall market not looking great there. In terms of Qs, those are starting to get a little weaker here. They've been holding up relatively well because the longs weren't there, but lack of growth or concerns about lack of growth starting to hit a little bit more. And I want to note one other sector here today. China. China looked really bouncy yesterday. It was like, oh God, maybe things are going well and we can start going back into like FXI and emerging markets and things like that. Today, that's already washed back out. We actually made a new low in FXI, KWeb, another ETF for the Far East for China. That got lower again. So yesterday was the bounce back. Today, it's like, no, that's not resolved yet. So one day bounce is not enough to give us any confidence on this stuff. Semiconductors, of course, stable still, and that's maybe the shining star in QQQ is that we've got stability somewhere. We've got stability in AI with Palantir. These are sort of the boring trades right now, frankly. We've gone from a mode of the exciting trade being Palantir and NVIDIA. So those are the boring trades. Got to focus on the energy sectors and things like that. Now, speaking of that, let's run through those weekly power trade and aggressive power trade named CF. Kind of going back into that bull mode, right? I think it's a spot to trim and then buying dips, but the dips, I didn't get in on that dip or that fall on Monday. Wish I had in hindsight. So if I don't have anything to trim, there's no trim here. It's not a go short, it's a trim and then build potentially back down at 120, unless there's that fundamental input that says this is actually getting closer to resolution. For here, I'm not, I don't think this is a spot to add. I think the add is on dips. EQT, same kind of story. It's a trend, and we're at the high point of the trend channel, so it's a trim, buying dips, right? Expedia, I still can't for the life of me understand why Expedia is good since the beginning of March. So something there is good, but we're still in a range bound trade. I think that we need to wait to see the breakout or the breakdown. And AI says the breakdown out is good, is better, but right now I just see a sideways market. And this is where I want to lean into CCL real quick, and then I'll come back to some of these other ideas. CCL's got earnings tomorrow pre-market. Now, this since the hoop hit the fan, in the Middle East, has dropped from 31.5 down to 26. Realized vol has been 63.5%. So it's been moving on average 5% a day over the last 10 days. That doesn't even factor in some of this wildness from the very beginning of March. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. These 10 days, that realized volatility has been very high. Okay. We're getting a dollar move every day. Normal earnings move is about 5%. So the day-to-day movement is in line with the earnings movement. So I don't see an earnings trade based on that. I think we'll see some implied volatility hit, and then there may be a better opportunity to buy some options tomorrow after the vol hit from earnings being resolved. So, suck out some premium from the market, push this implied volatility back to 50. And all of a sudden there's an opportunity here to trade around it at cheaper options. But I would just skip the earnings play and just trade the ranges after that if it was such an interesting idea. And right now I honestly just don't see it being that interesting, but certainly not interesting for an earnings play. All right, back to the weekly trader ideas. We got H&R Block. It's a rectangle. Once we get above 32 and change, I'm interested, but it's a rectangle. We rally to that resistance and then we pull back. We rally to the resistance and we pull back. It's a tighter one than Expedia, so it has a higher probability of getting something interesting, I think, in the near term. But right now, it's just not quite there yet. LYB is bullish, breaking out today. That's at that spot where I think it can be a long, and generally probably a long call. Like the realized volatility is 70, implied volatility is 53. It sounds high. Historically, high implied volatility is around 56, but a lot of this market's up in this range. This is just near the highs because it's not getting hit. So I think that there's an opportunity here for a long call, like a May 77.5, just near at the money. Could go April, a little shorter term. May has the benefit of having some earnings premium in it, so it shouldn't have as much of a vol hit if things calm down. But if we want to trade with the opportunities that are moving, a simple long call position can be a nice leveraged position that's got a big return on capital. And again, a lower probability of success. Maybe it's a coin flip, but if it works, it should work well enough that there's a positive expected value. And then back another energy name, Oxy, high end of the trend channel. So it's, buying dips and reducing at levels like this. So a lot of these names right now, like the CFs, the EQTs, and the Oxys that have a real trend right now or a real engagement, I think are in that trimming range. CF's not really trending the way that EQT and Oxy are, of course. Expedia and HRB are wait and see. LYB is a potential breakout, and so that one looks the best for me today. But when I go to the aggressive power trader names, we got FANG. Same problem as some of the other energies, high of the range, probably better to buy dips. But the other two names that are up there now are very interesting to me. So KMI, pipeline company, right? Pipeline stock, testing a breakout. I think this one makes a lot of sense here. It's another part of the energy sector that can appreciate in value, and the market is starting to hone in on that. So for those looking for some numbers here, they've got natural gas pipelines, generally natural gas, but they've also got refined petroleum products, crude, gasoline, diesel, jet fuel, crude, et cetera, whatever. So, they're all pipelines. And if oil demand is there and oil prices are high, that looks like that's something that can benefit from that. And we've also got PWR. A reminder on PWR, this one tends to trade a lot with AI. But again, infrastructure, electric and gas utility, power generation, pipelines. So these are two names or two within a sector that's not been appreciating since March. Great performance in January and February for both of these names, then sideways behavior. PWR down today. So still the rectangle. KMI testing the breakout today. Looks a little more intriguing to me. So with the aggressive power trader names in general, I like the long call idea. This is also beneficially for that. Yes, it's at near the highs of implied volatility, like many things in the market, but it's not exploded yet. If we break out, I think that there could be some call buyers out there. Now, in terms of trade implementation, again, it's all about personal preference. April gets more gamma, $34 calls, $34.50 calls, something near at the money, maybe slightly out of the money. We may only rally to 35, so I like the 34 calls for that if on the breakout. Same idea, May $34 calls seem attractive to me. I look at some of the other names that have had similar sort of formations recently, like an HP. We had that rectangle, and then we had the run from 36 to 38. Implied volatility here, realized volatility in HP is higher. But the same kind of concept here, where on the breakout, this didn't have the full push the way that Oxy did or EQT has had, where it's a real trend. These stocks, when they're breaking out of the rectangles right now, have been kind of push and then unsure whether or not to go. But maybe it catches like Hal, where it breaks out and then keeps pushing for 3, 4, 5 days. So if those are moving, 6% from breakout to peak, KMI should be at least, 3% from breakout to peak. It's about half the implied volatility, so half the realized volatility. So instead of 6%, I'm looking for 3%. Call it a buck. Well, a buck from 34 to 35. That puts those $34 calls $1 in the money instead of currently priced out at a little under 90 cents. And I think that there's some attraction there or some interest there, right? And on a dollar rally, just as a comparison, I'd take a strike lower. They go from, now 80 something cents to potentially $1.40, or the May calls can go from $1.20 to $1.75. It's a pretty decent looking, like 50% kind of return profit possibility. And if this all stalls out and they just pull back, I may take a 40% loss or 50% loss. So the edge here from that perspective is the potential for more than 50% and the probability being greater than 50-50 of an upside move on a breakout. So where we're at right now, questionable for a breakout. We start to pull back a little bit, but I think that still looks right, looks a lot like what we've seen recently in some other sides of the energy sector, like the Halliburtons. Or the HP, the drilling rigs that they do. So, I think it's an interesting idea. I'm going to look at it a little bit closer here in the next hour or two, but I think that's one that makes a lot of sense to me as a potential allocation today. So, from the AI signals, LYB and KMI would be my two focal points today for potentially building positions with like CF, Oxy, EQT is trimming positions, and then just trading around that sort of stuff. If that's the idea, like if I've got nothing but cash, What would I do today? That's what I would do personally. I wouldn't go and buy a bunch of Nvidia or Palantir. It's just not that exciting, right? If I want to go long term looks, I can go back to stocks like we were talking about SMCI and say, okay, on a dip back to 22, I could build something for the long term and then not worry about trading for 2-3 day moves. 20, 30 call vertical in December still makes sense to me. I can look at LRCX, which had looked good on actually, it doesn't look good today. Never mind. Thought it was still okay until this morning. Forecast toolbox. Let's see what else we've got, because, there may be some other non-energy related names that can be somewhat interesting here. Not seeing a lot of non-energy and non stocks that aren't exposed to the Middle East, but maybe Applied Materials, Monster Worldwide, kind of moving through some of the names. There's not a lot that have potential for some interesting upside, an AMAT. Actually, that looks really interesting there. That's like a normal looking bull. Yeah, it looks like LRCX did yesterday. Those are getting hit today. So probably pass on AMAT, just given the hit today. Teradata, nothing exciting there. Up and then back down. Monster, up and then back down. So yeah, I mean, pretty much the AI signals are saying if you don't want to trade stuff that has exposure to the Middle East, then you're not going to get to do anything for short-term momentum until something changes there, right? And I guess that's no surprise. But the investment community is not doing anything with that either, is what it's telling me, right? Like they tried an AMAT, they tried an LRCX, and today they're abandoning that. I mean, heck, look at Micron. That's testing lows here. And I think people are starting to get worried about some of these tech names that have been bullish getting a bigger hit if we hit some liquidation points in the broad market. So, yeah, let me see if there's anything else that's particularly interesting. Oh, I just showed Mara. The decision to buy back convertible notes is benefiting the stock because now you've got less risk of dilution as they cover out those convertible notes that they were putting out before with the Bitcoin that they sold. 15,000 Bitcoin is a big chunk of cash. They're no longer the second largest holder of crypto. MSTR is now the crypto holding trade if and when crypto gets more exciting, and that much more. Marathon, Mara Holdings was, and I'd say no longer is. They're pivoting. So they have to be looked at a little bit differently now and not necessarily bucketed as much with like MSTR or HUD or BTDR. A lot of these names are starting to get more AI focus and kind of diversifying their exposure away from crypto. Yeah, USO is up at 116 right now. All right, let's see what else is moving sector-wise. Which sectors look the most vulnerable to me right now? Yeah, I would say I haven't looked at XLU today. I just wanted to check that. Yeah, that's too low. I'd say the most vulnerable might surprise you. Could be this SMH. So the way that Micron is pulling off, and now that I'm seeing AMAT and LRCX pulling off after showing some initial signs of bullishness, I get concerned that SMH is going to have some serious potential downside. This has been such a good run for a while there. Let's see, Jets. Yeah, that's not. I mean, it's up over the last 2 weeks, but that's not doing anything exciting there. Somewhat interestingly, over the last 2 weeks, the best performing sectors look like this, right? They're best performing, quote unquote, because they're not making new lows um, after making their new lows early in March. Um, it's RG. That's a genomic revolution. Pass on that. ARC Innovation. The innovation ETF stuff like this, like a lot of that stuff that requires capital raising for growth. If interest rates go higher, I worry about what these things can do. And when they're testing these low points, I think of like what we've been doing over and over or recently in ARC is, it's like stability and then fall, and then a little bounce, and then a big fall, and a little bounce. This looks like it could get bigger ready for a bigger fall. So thinking through like some of the tech names that need capital would be the concern, right? So that could be a lot of AI names. It can be the quantum computing sector. Technically, quantum computing looks very, very risky right now. We had this consolidation in IONQ, and then when it finally breached, you get a big pullback from 45 to 31. That could happen again. IONQ is the biggest. QBTS has already started that fall. QUBT has already started that fall. Actually, QUBT bounced back a little bit this week, but these are names that have already started to breach, and they seem to have more and more downside. And the excitement over quantum computing from Q3 2025 has certainly waned. I could see these names being very at risk when we're no longer caring about AI. And then the sort of derivative element of once AI looks overvalued, people look for the next growth sector that's maybe longer time out and more capital to raise to get there. So like as much as I would say I like bias wise, I like the upside potential of all of these names. In the short term, they look very vulnerable. And so I would say on a trading opportunity, they look to the downside. And we're real close to saying that I think IONQ is a put buying opportunity, but that implied volatility is really high right now because of the consolidation. Long term, a reversion to the normal, like an April 30 put. If we get below that, there's not much option support below it. All the open interest is 30 and not much below. And so we may see some panic here in the near term. So I would look at IONQ as a potential short. Seagate, another name that's been like anything that's been good in the tech side seems vulnerable to me. So those best performing stocks outside of energies, anything tech that's been good. Let me see if there's anything on my that's like Dell. I don't know. Let's see. Oh, MRBL. MRBL, people were buying it right now. Dell, people are still had been buying it up a bit. This is feels like a revenge trade, but it's sort of built on this idea of if we can find a top out, as long as I define the risk, I don't feel too bad about buying a put, because the liquidation side of things, if people start to just sell everything, they sell the baby with the bathwater. This is the good stock that has downside. So, kind of looking at the extremes, right? The stocks that are at lows that look like they can break within tech, the stocks that are at highs that just have liquidation risk in case the profit takers turn into selling everything. And the stuff in the middle, yes, I think Palantir would be hit in that scenario back maybe to 130. but it may be less. Well, Palantir may be okay because of the rectangle is coming out of. Let's see about like Nvidia. Nvidia is getting close to the lows again. Any of these things that are getting close to lows. You said Microsoft. Microsoft, I think maybe feels a little too late. It probably can still. I mean, it certainly can still go lower, but it's already a little bit in that trend. So like selling into rallies. If I want to sell into a break, if I'm waiting and looking for something that I can get into when it's first breaking through, I think that's like the IONQ side of things. And then yeah, like going and saying if that doesn't get caught and we see SPY get below 645, I think we can get into sell everything mode. So then it's just find a stock that's high and sell it. Kind of like when we're spiking to new highs and all of a sudden all the cheapest stocks in the world that have no real value start getting bought up because people just say, I got to find value anywhere. We're at that point on the other side where bullish stocks can get sold and then liquidated quickly. Yeah, I didn't realize how low Microsoft had gotten here. I was still thinking of it as a $400 stock and it lost another 7%. I mean, I knew it was down. I didn't realize it. I didn't look at it this week, really, or the last week and a half, because I really haven't been looking too much at tech for obvious, for whatever reason. How's Netflix doing? I haven't looked at that much since the bounce back. That's just stable up there. Okay. You're like Meta. Wow, Meta. Taking it on the chin as well. I can honestly say I've not looked at the Mag 7 here in a week or two. And those stocks are getting hit. And part of it was because QQQ was just so stable. So it was like, well, why focus on the stuff that's not moving? But when I dig back down into the Mag 7, there's definitely been some trend downside here in like Microsoft, Meta, some of the more AI heavy names. Amazon stable, so this would continue to be a I don't care stock. Tesla, it's just a grind lower. Probably a setup now to just go back for puts here because it's like bounces are sold. So looks like it can go down to 365. Yeah, I mean, I think that's a unfortunately accurate view, Mario. It's getting kind of scary here where some of the big tech names are getting pulled back. And the lack of follow through to the downside is being held up by sectors that didn't collapse for the last 2 weeks. So, like financials, it's energies, and then sectors that just stopped going down for a little bit that are holding us up. People rotating their short. Like, okay, the financial bearishness already played out. So now which sector do I want to go for? So I'm covering my financials and then I'm going to sell out something else. Healthcare is normally a safe haven. That got crushed, right? So now people are buying it back and moving to something else. XLU, normally a safe haven. Last week that got crushed. So people are buying that back and selling something else. But much like when we get the market rotation within a bull market, we seem to have market rotation in a bear market right now, So it's definitely an active trading setup, but definitely looks like it's got. There's a lot of stuff out there that just has so much downside. There's another one, maybe like HPE, Hewlett Packard, kind of like Dell. Like, yeah, these stocks have been going up. They've got some fundamental stuff going on that's causing bullishness. But when the market liquidates, they stop caring about which stocks were bullish and say, well, I better sell some winners here because I got to sell some losers. I'm selling losers. I might as well sell some winners, That's the falling knife scenario, though. So I guess from that perspective, if SPY is continuing to hold up above 650, above 645, maybe those stocks like Dell and HPE don't get hit. But if I'm shopping for value right now, think the last thing I'm looking at to buy is Dell or HPE. So if I'm bullish looking for something that can go up, I'd be much more inclined to say, fine, I will go back to a little bit safer, but if I want some risk, maybe it's Palantir. If I don't want risk, maybe it's Apple. You know, if I don't want a ton of risk, but I want some AI exposure, maybe it's Microsoft. You know, the value shopping there makes more sense than buying the screaming highs in Dell and HPE. And it doesn't mean Dell and HPE can't go higher, but I think that they need a recovery in the market to go much higher than this, you know? And if that's the case, if that's the scenario that plays out, there's a lot of stocks that'll go up in that scenario. My concern would be the downside if it plays out the other way. I think there's greater risk to the downside than other stocks and maybe less reward to the upside than other stocks. And if that starts to play out that way, those could be the most vulnerable, even though they may fundamentally be better off than a lot of other companies. Or heck, even ARM. You know, they just had a good announcement yesterday about having their own chip. Market can forget that real quick if they only want to focus on the geopolitical risk and say, never mind, I'm selling ARM because I got to sell everything, you know? So, yeah, I guess my personal preference in terms of like the short style is to look at like the IONQ type setup. Forget my underlying view that at some point this could go back to 85. And so there's that excitement about that. But heck, that's only 2.5x, you know, and an IONQ that doesn't sound nearly as enticing as, I don't know, some of these other names that have had that parabolic shift in the past. Heck, like HIMS, not that it has anything to do with tech. That's at 20, and so that could triple, or MSTR. That's at 137, that could triple, you know? App Lovin', it's down at 400, that could double. That another one that possibly could be a big risk because it's such a volatile stock, and people have had big bearish views on it. And if interest rates continue to go higher, it's already down 10% today, but it's not quite at the point where I would have been saying, oh, this is a selling opportunity. I think the new low is where it's a selling opportunity, but there's a lot of names out there I think that can grab onto it. And IONQ is more of that stable, has been drifting lower, and then could turn into something more dynamic to the downside. If I want to take the stock that's had a lot of pressure and then people finally capitulate and sell. I guess that's the best way to phrase it. Like the stocks like IONQ are towing the line of capitulation selling if anything is left. Stocks like Dell are at risk of just people liquidating. So capitulation selling versus liquidating winners. Yeah, and everything in between is just, you know, maybe a little bit more market beta. And then if that's the argument, then go to SPY or QQQ. All right, folks. So for that, this is the one I'll probably be looking at today. This is another one I'll be looking at today on the long side. And we just talked about the short side. And that's kind of it for me for now. And yeah, I still say it's kind of a low risk environment. You know, trade small makes more sense to me than trading big. You know, others might argue that, oh, when things are moving, you got to trade bigger because that's where the opportunity is. I'd say when things are moving, trading smaller allows me to widen out my stops a little bit more for the same risk. So if I want to trade bigger, I got to really have tight stops, and that may chop me up a lot, you know? All right, guys. Thanks again. Yeah, so I hope you can join us at 1 o'clock Eastern. Check your email for that. And if not, hopefully at least the closing bell today or morning bell tomorrow. And best of luck today. We'll see how this market plays out. But yeah, chopping bearish. Thanks again.